Hello, everyone, and welcome to my live session, which is dedicated to introduction to my software, System Trader. But before we will start, I will be very grateful if you could let me know in the comment if you can hear me and see me, because that's quite important before we can proceed. And in the meantime, I'd like to just explain you what I prepared for today, and maybe I will make it a bit bigger so that you can see it better, hopefully. Yeah, I think. So, who am I? So, basically, I'm running a podcast and a blog, and mostly it's a podcast, System Trader Show. So you can see the link here. Hi, George. Thank you. And privately, I'm a software engineer, and just because of that, I'm also here because I had a problem that I wanted to invest the money, but I was looking for a tool to it. So therefore, because I'm a software engineer, I thought that I can just create it myself. Thank you, George. It seems that I am visible and you can hear me. So that's great. We can continue. And so just to let you know, I'm not a professional investor, but I think that most of us, even if we are not a professional investors or we are not working in the financial industry, we have to invest our money because this is the only way how to wisely put aside money and let them work for us. And I have prepared a tool which is allowing us to do it in a smarter way. And by the way, here's the screenshot from my website, System Trader. So I encourage you to visit my website. And what I will say today, I will make a very short introduction to investing so that even if you are really a beginner, you will or you should understand the main goal of investing and why in fact we have to invest, and also how the System Trader software can help us to do it, because it's not that we will have to be really a professional investors or traders to invest our money. Not at all. I think that what we need is to have a reliable plan and then follow it. And after that short theoretical introduction, I will make a quick demo of the System Trader software so that you can see how it works. And I'm not promising you that you will get a quick recipe for how to become a rich person, but at least what I will show you today is that you can really approach investing in a wise way. So let's get started. I had last year on my show Meb Faber, and he said very great words that thousands of years of human evolution in the savannah of Africa have not prepared us to trade Amazon and Google stocks, interest rates, commodities, or other financial instruments. And many correct investment decisions are contrary to our daily life intuition and experience. And I think that these words are very, very important, that we need to have a plan. We should not speculate on the market. We should not try to time the market without any kind of preparation, any kind of plan, any kind of strategy. And by the way, if you are willing to put aside money in a wise way, you have to be very patient. It's not a quick win. It's not a speculation. You don't have to be very educated or knowledgeable, but you have to have a plan which is making sense, and the plan which you can stick with for years. And I will demonstrate such a few examples of such plan in a while. And how System Trader software can help you. So first of all, in a System Trader software, you don't have to reinvent the wheel, because just when you open it, and I will show you that later, you can see built-in strategies which are already there. So you can just use them if you want to. Of course, you can also build your own, but there are for now over 40 ready-to-use portfolios and strategies, both passive and active. And I'm not trying to be here dogmatic that you cannot be active, but I'm trying to convince you that whatever you do, you have to have a plan for that. So probably most of us should have passive portfolio and maybe some portion of active approach as well if you want to, although that's not mandatory. But if you really want to be fully active investor, then you have to really very well understand the risks you are taking. And as I said, probably being a passive investor is just enough for you to become a successful investor and to meet our goals long term. And the funny thing is that the speculation is so attractive to many of us because you can quickly have a great result. But the problem is that the longer you do it, the less chance is that you will be really successful. Whereas with the investments, long-term investments, it's quite the opposite. It's very unsexy in the short term because it's very boring. But on the other hand, the longer you do it, the more chance for being successful you have. And in fact, after decades of long-term investment, following a passive portfolio or let's say semi-active portfolio, you have a big chance to be really successful, and I will show you proofs for that. So basically, when you open a System Trader software, you can find already examples which you can follow of portfolios which were developed by some outstanding investors. And of course, you can adapt them to your own needs so that it's very important so that they will exactly meet your requirements. But what is very important is that you don't need any special technical skills to use that software. So that really you just have to only open your mind and think reasonably, but you don't have to have any kind of technical expertise. But you have to prepare that you have to do some homework, which will require you hours to work a bit on that. But on the other hand, think. This is a plan which should work for you for next decades, so that it should not scare you that you have to spend maybe even a few days on preparing a plan for your life, in fact. So this is the first, let's say, pillar, that you have built-in strategies and you can build your own strategies as well. The second pillar is that once you have that, you can backtest it, and you can backtest it using really exceptional data, which is going back to even 100 years and in some cases even longer. And this is very important because most investors only look at the latest results. It's a kind of a recency bias, which may be very dangerous because you may take the wrong conclusions. Just looking on the S&P 500, let's say for the last 3-5 years or even 10 years, you can think that it's such a great vehicle in which you should put all your money because it makes 15, 16 or 17% per year. So that's great. But if you will extend your history in the backtest, you will notice that it's not always that exceptional. And there are periods, and sometimes quite lengthy and extensive, that you will have to go through major drawdowns, like even going deeper than 50%, and sometimes they last for years. So you have to be aware of that. And also, if you are investing long term, you have to know that even if the things which are cannot be expected every day, but if you are investing for decades, some very rare or extreme situation eventually will happen. So that is good to see how your strategy really performs in different regimes, in different conditions, in different environment. For example, in rising or falling interest rates, or in high inflation or low inflation, during some revolutions, even world wars. And I'm not trying to be here a very negative guy, but just keep in mind that your portfolio should be really anti-fragile. I mean, it has to be really very durable, even if some major crashes will occur, and it's a matter of time that they will occur. And you cannot just afford that after, I don't know, 10 or 20 years of putting aside your money, your savings, building your capital, that after 10, 20 years you will lose everything just because you haven't been prepared for a major market crash. Of course, it's not about forecasting, because I'm not going to tell you what will happen tomorrow or in next couple years, because no one knows that. And if you hear someone who knows, who's predicting what will happen, obviously he's just lying, because no one knows that. So that software is not about that you have a machine which will make money for you, but you have a solid, reliable set of rules which you can follow, and which I'm pretty sure will make you successful once you will be disciplined enough. So that's number 2. And the number 3 is what I already said. Follow your plan, not emotions, and don't try to do any kind of forecasting, because it's really, you will just lose your time, and unfortunately, you can also lose your money. So base your decisions on proven and reputable methods to avoid mistakes resulting from our psychology. And by the way, if you are a passive investor, in fact, you really just don't have to think about anything in terms of what will happen next, because you just only stay the course, as Jack Bogle was saying. If you are following active strategy, you may have a bit more tougher time, because you may start thinking if your strategy is still working, is it still efficient? But still, as I said at the beginning, I'm not dogmatic, so I do believe that there are strategies, active strategies, and at least you can put some portion of your capital in your active strategy. And I think it's quite good, and I will demonstrated this in a while, how it may work. And what is very important is that if you want to invest your money, you don't really have to spend a lot of time. You don't have to have 10 monitors around you. In fact, good investing is very boring, and it may take you only a few minutes per year, really. I know it sounds unbelievable, because a lot of gurus, charlatans, will try to convince you that you have to spend hours each day on investment, because this is the only way to go. This is quite the opposite. Actually, really, you can spend only a few minutes per year on your investments. And if you are following the right rules, the verified rules, then you can be really very successful. So there is no correlation that the more time you spend, the more money you will make. Actually, if there is some kind of correlation, it's the opposite, that the more time you spend on the market, it's quite possible that you will make less money, because you will try to be smarter than the market, which is not that easy. So the main goal for System Trader software is that I wanted to enable anyone to develop an investment plan simply and quickly, so that you don't have to have any special technical skills, and you can just build a plan which you can verify and then apply on the market really easily. And just a short history of the System Trader software. So I started my podcasting at the beginning of 2018, and the first lines of code of the software were created at the end of 2018. So basically, I'm already creating that software for more than 3 years. The first, let's say, public beta version was available in May 2020. And just in March 2021, I presented the first version of that software available to the public. And currently, in October last month, I have released the version 1.3. And as you can see through the history of that software, this is still being developed. By the main parts are already there. So of course, in time it will become a better solution. It will be more user-friendly. It will have more functionality, but the basic part is already there, which is enough to build a very reliable long-term solution for you. So let's make a quick demo, and just to make it more visible, maybe I will just hide myself so that you can see the software better. Hopefully you can see it. So this is the main screen of the software. And don't feel overwhelmed by the number of details you can see here, because after spending some time with it, it will become really peanuts for you. The main screen here is already when you open the software for the very first time. On the left side here, you will see the number of built-in strategies and portfolios, and the biggest chunk of that is just a passive approach, the pie chart investing. There are over 40 built-in portfolios, which you can just see how they are built. We will go into a bit more details in a while, but even if you are really the beginner, you can already take some, let's say, inspiration from ready solutions. On top of that, you have also currently two active strategies. The Dual Momentum by Gary Antonassi. It has been introduced by Gary Antonassi. I really have a huge respect to Gary Antonassi for what he's doing and how he's doing that and his approach. So he introduced us a dual momentum, and especially the global equities momentum, which I will explain in a while in more details. It's a very simple strategy, yet very, very powerful, and it's an active approach. And there is another active strategy called Advanced Equity Momentum. This is for, like the gem is, here you can use, for example, ETFs. That is for individual stocks. It's also based on momentum, which I will explain in a while, but it's, let's say, a bit more complex. But also, as for the logic itself, it's pretty simple. So this is the main screen here. And also, if you are the beginner, you can find here some educational corner, let's say. It's a curated list of some articles or video materials or podcasts which can help you to learn more about what's behind, let's say, some educational materials. So this is the main screen, and even from here you could already start testing these portfolios, but we will do it in a second. So let's start with the passive portfolios. As I said, we have over 40 built-in portfolios already here. And let's start with something very, very simple, like, for example, the 60/40 portfolio, where we have 60% of the stocks from the S&P 500 biggest American companies, and we have also bonds. Like in that case, we have 7 to 10-year treasury bonds. And of course, ETFs, the exchange-traded funds, which are listed on stock exchanges, their history is pretty short. It's like 5, 10, sometimes 20 years. But actually, it's very difficult to see how such portfolios are working in the long term. But here we have the built-in data, and that allows us to go really far in our backtests, because we can go even up to the beginning of the 20th century, over 40 years. If we go into the details of such portfolio, we can see here, of course, description, and we can see, for example, the currency, the starting capital. We can see how often and with which strategy we want to rebalance our portfolio, because the fact that we have here 40% of bonds and 60% of stocks, that's the model portfolio, but it will happen very soon that these weights will just deviate, and we can have, for example, instead of 60%, we can have 65 or 70% of stocks, because stocks in long term, they are growing faster than bonds. Therefore, we have to rebalance them, and because of that, we have to just decide how we want to do it. I will not go now into the details, but you can just see the descriptions there also, and then you can just see how this rebalancing is working. And by the way, this is, at least at the beginning, not the most important aspect of passive portfolio. Of course, it is important, but not that important that you have to now fully focus on that. This is, let's say, a step number 2. So I will not follow, I will not go into a deeper details today to not lose the overall picture. You can also decide what are the components of that portfolio. So that, like here, we have only 2 ETFs, and we have also the backfill data, which is allowing us to go further than the ETF would allow us to go. We can also express our portfolio or convert our portfolio to different currencies. So, for example, if you are not located in United States and you would like to see how your portfolio is working, if you are converting this to euro or to Japanese yen or whichever currency you are using, then it's very helpful to see how that portfolio is performing in your local currency. Here are the transaction costs. So of course we have to buy and sell the ETF, so we have to have some costs. And the cash flows. For example, you would like to see how your portfolio is growing when you are in the phase of accumulation, when you are putting aside regularly some money. For example, you would like to contribute some fixed amount of money every month or every quarter or annually, and then you just define some contribution amount. I see some questions there showing up, so I will answer them a bit later. So please be a bit more patient. But I promise that I will get back to any question will be in the comments. So this is it. And now someone can ask why I need to have a long history of testing such a simple portfolio. Let's say that we are checking such portfolio from 1981 till the end of 2020, and we can see that that simple portfolio was making over 10% per year, and after adjusting to inflation, it was making almost 8% per year, and maximum drawdown of such portfolio was 31%. So you could say not a bad thing, but the thing is that, of course, you can go into the details here and you can see more how it worked really over long term and how the equity line looks. You can check even month by month how your portfolio was working. Of course, these green fields means that it was a positive month, and whereas the red one means that the return was negative. You can see how year per year it was performing, and you can also see the rebalancing history. So that software will also help you to monitor your portfolio and tell you when you should rebalance your portfolio. For example, here on the 2017, we had 68% of S&P 500, and there was a rebalancing. So again, we have 60% of stocks. And you may ask, do I need anything more? If I will just check like 40 years of data, that's enough. Well, I did another test here, and I just made it before to not lose your time, but I made that test from 1940, because from 1940 the interest rates were going up, and maybe we are in the same situation currently because the interest rates are really on a very low level, so therefore there is not so much room to decrease interest rates. But we may end up in the situation where in the coming years these interest rates will be on the low level or they will increase. And we had such case between 1940 till 1981. And in fact, the same portfolio was making now almost 8%, but before inflation. Look at that. Between 1981 till today almost, we were making after inflation almost 8%, whereas here we are making 8% before inflation, and after inflation, instead of having 8% as in the last 4 decades, we are having only a bit more than 3%, which is twice less than we had in the last 4 decades. So as you can see, there are things which you cannot see if you are just looking on the recent history, and that's why it's so important to know how the markets were performing in the further history. And by the way, if you look here on the 1940, 41, 42, 3, 4, 5, during the Second World War, you wouldn't guess that there was during that time the Second World War. I would say business as usual. I mean, the markets were just working in the way that if I would remove this year column from here, you would never assume that it was just during the Second World War. So that's another hint that you should follow your plan rather than emotions. Because if you would read newspapers or you would read or you would listen to gurus, you would probably be so afraid of investing or doing anything based on emotions that your decisions would be really very bad. So that's why you have to have a verified plan in your hand and follow it. And of course, this is the built-in portfolio. You have, like I said, over 40 of them. And you can, of course, build your own portfolios here if you would like. You can add another one, pie chart investing, and you can create a new portfolio based on your requirements. And there are a lot of videos on YouTube which you can follow to see how I'm doing that. So I will not make it now to not lose your time, but there are shorter videos which are showing you, for example, how to build a simple portfolio, how to test it, and other details. So this is about the passive portfolios. And as I said, in passive portfolios, we don't try to do any kind of forecasting or any kind of predictions. We just invest in the broad market, very well diversified. We have to be very patient. We have to have a long time horizon and let the market do its job. So now let's talk about active approach, global equities momentum. And to be honest, this is one of my favorite strategies. Although it's an active strategy and some people are trying to be dogmatic and saying that, oh, you should keep aside and you should avoid any kind of active strategies because they are very dangerous. I think that that particular strategy is very, very nice because it's very logical. And by the way, if you open my software, even in the demo version, I encourage you to listen to Gary Antonassi interview I made in my podcast. He's the author of that strategy, and here's also the description of that strategy, very short one. I also recommend you to read his book. And as the name implies, there's a global equities momentum. So we have so-called momentum. And momentum is a well-studied anomaly where markets with strong relative strength, or which are just going up, they continue outperforming. While if the markets are going down, they continue to underperform. And typically, momentum we are checking in the period of the last 3 up to 12 months. So, for example, if in that particular case, the S&P 500 return for the last 12 months, for the last year, was positive and was higher than, for example, MSCI All Country World Index, excluding USA, the rest of the world except the United States, So if the S&P 500 was having positive return and higher than the rest of the world, then we would like to keep S&P 500 in our portfolio, and we check that condition every month. On the other hand, if none of these equity ETFs, because we can implement with ETFs this strategy, neither S&P 500 nor MSCI All Country World Index, excluding USA, would had a positive return in the last 12 months, then we are going to bonds. And as Gary says here, by combining trend following, absolute momentum, and traditional relative strength momentum, investors may increase their expected return while reducing volatility and severe bear market drawdowns. And just to explain you, or just maybe show you the real example, let's do a backtest of that strategy for the last 70 years. All right. So let's make it like that, and I will just press the test button. And yes, so now, as we can see, it's being calculated in the background, 70 years of data. So it takes a few seconds until we'll see the results. But I'd like to show you how that performed. And obviously, this is the historical, this is the past data. But as you can see here, and as a benchmark here, you have the S&P 500. From 1950 till the end of 2020, that strategy was making, on average, compounded annual growth rate over 14%, whereas the S&P 500 was making over 11.4%. And it sounds like not a big difference, but it's a huge difference, because the end result for that strategy for global equities momentum is about more than 5 times bigger than the S&P 500. And after adjusting to inflation, on average per annum we were making around 10%, whereas the S&P 500 over 7.7%. But this is not the biggest thing. It's even more interesting when we look at the maximum drawdown, because here for that strategy, and this is the monthly data, so therefore you need to keep in mind that it's not that the precision is lost, because we have only the end of month data. We don't have information what was happening during the month. But with the end month data, and the same is by the way for S&P 500, the maximum drawdown was over 23%. In reality, it was slightly above 30% if you would consider the daily data. But this is still like twice less, or around twice less than S&P 500. Of course, we could go further than 1950, but I'm not doing that for the reason that basically Gary Antonassi was describing on his blog post, that before 50s, in fact, investing globally wasn't that possible. Therefore, the data is not very relevant. But if you would go back further in history, this result will be a bit not that positive, as you can see here. They will be a bit more negative, but still this strategy is beating the market for the period of last even 100 years. And it's very simple to use it on a daily basis, because you can just spend only a few minutes per month just to see if you have to do anything in your portfolio. There's a short video on my YouTube channel where I'm describing that strategy, so I encourage you to see it. If you look at, for example, the equity line, and here because I have a small screen, so I will increase it. The blue line is the S&P 500, and the green line is the global equities momentum. And the momentum is really very well known anomaly on the markets, and it's also widely accepted by the academia. So it's not like it's something which just appeared out of the blue. It's really very reliable strategy, although I would say that it's not that simple. But with no strategy, it's simple to to be disciplined and to follow it, because it looks so attractive here in long term, but you have to go through the periods during which you will your portfolio will be performing worse than the market. And even in the last years, the global equities momentum, although it's beating S&P 500 long term, in the recent years it's worse than S&P 500, because that strategy is very good if we will see a longer bear market on the stocks. Then that strategy will show us its advantage, because at some point it will move us to the bonds, and once the market will rebound, then we will be again in stocks and we will avoid the huge losses. This is just in a very short description here right now, but as I told you, I encourage you to listen to my interview with Gary Antonazzi and to read his book, and also to see the video dedicated to that strategy on my YouTube channel. So this is the global equities, and here in the settings you can define different things. Basically you can define, there are 3 ETFs involved. You have either S&P 500 or the rest of the world, let's say, so world excluding USA. And also you have some bonds. So this is the global equities momentum strategy. And now the advanced equity momentum. This is so far the most advanced, in fact, really, as the name implies, strategy I have implemented. And that strategy is based on the idea taken from the book Stocks on the Move by what was the name of the author? Andreas Klenow. It's a Swedish guy who's living in Switzerland, and he's running some hedge fund there. And basically, this is also the strategy which is based on momentum, but it's selecting individual stocks based on momentum. So it weights individual stocks. It measures the momentum of each stock. And then, depending on how we set the details of the strategy, how we will configure it, it will pick up the stocks which have the strongest momentum, or in other words, the stocks which are growing, let's say, in the smoother way up, because we also are excluding the stocks which are going like rocket to the moon, because they are maybe too much volatile. But you can just play a bit with the settings here. And also you can say that, for example, you would like to have no more than, let's say, like here I said, you can say that you want to have the portfolio with up maximum, let's say, 15 stocks, and that you would like to rebalance your portfolio every month. So every month, software will make a ranking of stocks from some universe, let's say from some index, and then we'll pick up the 15 stocks with the highest momentum. And some example I prepared here for the Nasdaq. Maybe I will close this so that we'll have more room. So I prepared 2 backtests for Nasdaq. So from Nasdaq, we are picking up every month 15 stocks out of the 100 with the highest momentum. And for the next month, we are doing nothing. Of course, you can change that period. You can do it monthly, you can do it weekly, you can do it quarterly. I personally do it quarterly, but here we see an example where from Nasdaq, we are picking up stocks each month, 15 stocks. And this is with quite aggressive settings. So you can see benchmark the Nasdaq 100 here. And as you can see, on average, the compounded annual growth rate from 1999 till today was over 10.4%, but the maximum drawdown was over 80%. That was the tech bubble at the beginning of 21st century. Whereas the strategy here was making over 12.4%, so it beaten that Nasdaq index. and the maximum drawdown was lower because it was 50% rather than 80%. Still very huge, very deep drawdown, but as you can see clearly, it was able to beat the market, and also the volatility of our strategy is smaller than for the whole index. How it works in reality, you can see here that each month you have a different portfolio with different stocks. So each month the software tells you what to buy. And for example, here you can see that we had partially bonds in our portfolio because there were not enough stocks with a high enough momentum. So we had partially bonds in our portfolio, and that's the nature of that strategy. Depending how you will configure it, that you don't have to always have 100% in stocks. You may have sometimes also some cash or bonds if there are not enough stocks which are in uptrend. But what is very good is that it's purely quantitative, and it's very versatile, and it's very flexible. So it works on actually basically any stock market. Here I'm showing you Nasdaq, but it works also on other stock exchanges. I personally, because my origin is Poland, I use it also on the local stock exchange in Poland, and it works beautifully so far, really. So also, again, you have to have a long time horizon. You cannot expect that you will have a great results in a short period of time. You may have, but you probably may have great results if there is an uptrend. But if you are having a bad luck and there will be a bear market, then even such strategy will not make a miracle, because the stocks, it's hard to make money on the bear market with stocks. So just to let you know, I'm not selling you here any magic pills. It's just a tool which works, and it's quantitative, and it's verifiable. You can verify the results, and it's repeatable, but it's not a magic pill. But if you would like, and this is a great advantage of that strategy, be more conservative, then you can put less risk in your portfolio. And again, we have Nasdaq 100 here, but look, the compounded annual growth rate is lower than the benchmark. So you could say that we were beaten by the market. Well, yes, almost 1 percentage point, the compounded annual growth rate was lower in our strategy than on Nasdaq. But look here, the maximum drawdown is below 30% now, whereas on the index it was over 80%. And also the volatility, the portfolio standard deviation, it's a standard deviation of the annual returns, how the portfolio is volatile, it's below 10%, whereas the index itself is over 30%. So as you can see, the risk-adjusted return, or for example, Sharpe ratio here is over 1%, whereas for the index is 0.48. So although the compounded annual growth rate was lower, in fact, we cannot say that we lost against the benchmark, because we had significantly less risk in our portfolio. So this is the strategy which is more active. And also, if you would like to learn more about that strategy, I encourage you to listen to Andreas Klenow. It's the guy who I told you was actually it's inspired on his book, but it's not exactly what he's describing there. But if you'd like to know more about it, you can just read his book, and definitely you should go and check my interview with Andreas Klenow. And also you should I think watch the short video which is on my YouTube channel, which is fully dedicated to that strategy. So advanced equity momentum. And basically now we have, as I told you before, over 40 built-in passive portfolios. You can create your own ones as well. And you have also these two active strategies, dual momentum, global equities momentum. That's the first strategy, active strategy, and the one which I described just now, advanced equity momentum. So this is about the strategy. And now a bit about the data, because I think this is very important. The data, it's like the oxygen, because we have to somehow do our backtesting. And when it comes to the data here in that software, there is a data which is built into the application, the historical data, and which, as I told you, is going back to even the beginning of the 20th century, over 100 years. So, for example, if you go to select symbol, and then if you go to the system trader group, so-called, it's like a folder, you will find built-in data here. And most of the stickers here are going back for decades back in history, and it's built in. It's the end of the data is the end of the previous year, but each year I'm extending the data. But this is not a big deal, because you can extend that data by the ETF. So obviously, if you'd like to make the test of the S&P 500 for the last 100 years, you couldn't do it because there was no such thing as ETF 100 years ago. But with that data, built-in data, you can go back 100 years, and then for the last couple of years, you can cover the test using ETF itself. So that's one thing, the built-in data. But that's not all I'm offering in that software, because you also have here the whole menu, the data menu, where you can import any data you like all over the world from over 70 stock exchanges. And it's included in the price of the software. So you don't have to pay or look for some extra data somewhere else. You have it already on board. If you click on import, you can see countries. Basically, you have all major markets here. So it's very difficult to not find something here. And for example, let's go to USA, for example, and USA stocks, for example. If you press next, then you can either import stocks, or you can import ETFs, or you can import mutual funds. So you have, like you see here. So basically, really, it's a lot of data in it, and you can import it. And also, it's daily data. And this data, these companies, they have like around 30-40 years of history, by the way. So if you'd like to test like advanced equity momentum strategy, which I mentioned before, you can do it because you have that history also included with that data. By the way, if you'd like to import, let's say, all the stocks from a given index, currently I'm supporting around, I don't remember, around 60 or 70 indices. And let's say that you'd like to use the advanced equity momentum on S&P 500. So you just enter S&P 500 or ASX if you are from Australia. And then you can just import all the stocks from the S&P 500, and you don't have to pick one by one stock from the S&P 500. You can just import all 500 stocks in one batch, because it's a predefined list of stocks from that particular index. So that's very important as well. And then you can very easily update that data. So basically, you can just press here which data you would like to update, and it's done. And as I said, it's a premium data, because it's not data from like also you have access here from Yahoo or some other free sources, which are not always reliable. Here you have the data which is coming from the source which is paid by me every month. And it's a premium data because it's cleaned, it's really high quality, and you can rely on this data. But if for some reason you wouldn't find here, which, as I said, you have access to over 70 stock exchanges worldwide, but if you wouldn't find something here, you can still import the data from the text file, or you can also get access to the Norgate data, which is a great source of data for American and for Australian market. And also you can have access to the data from Yahoo, which is free. But as I said, it's more like backup data. If something wouldn't work here for some reason, or you couldn't find it, which is very unlikely, you can try to find it in Yahoo as well. So this is about the data. And now the last bit, the charting. Actually, I wasn't talking too much here about charting because, in fact, this is not really day trading software or technical analysis software. But if you'd like still to look on the charts, you can do it here as well. For example, we have Apple. And as I said, you have access to the data from the whole world, actually. So you can look at it here. You can play with it. You can even apply some averages, bands, and so on. All this technical analysis toolbox is available here. So if you'd like to look at this data you have there, you can do it as well. Not a problem at all. So this is it, I think, for now. No, just one more thing I would forget. ETF directory. And this is now only for the people who are using the ETFs which are listed in Europe. The problem in Europe, that's the reality, is that most of the investors in Europe, they don't have access to ETFs listed outside of Europe, especially in United States, which are the most liquid ETFs. And in Europe, we have an extensive number of ETFs as well. There are a couple of thousands of ETFs. And if you'd like to invest using these ETFs from Europe, you have the directory here, which is having over 2.6 thousand ETFs, where you can check all the details here of each ETF. So if you are looking for some ETFs from Europe, then the ETF directory is for you available. And I think that this is it for now. And what next? Maybe I will just show myself that I'm still here so that it's not only my voice. Maybe just give me a minute. I will just drink a bit of tea. Excuse me. So what next? In my latest version, I added multi-currency support, which means that you can convert each portfolio result into a different currency, which may be important if you are not living, for example, in United States and you would like to see how your portfolio is performing in euro currency or some other currency. Also, I have added this cash flows mechanism so you can see how your portfolio is performing during the accumulation phase, where you are contributing, you are putting aside some money into it, and then during the consumption phase, when you are withdrawing some money from your account. And then what's next in the pipeline? So multi-strategy, so that you can, for example, say, okay, so I will build my portfolio, long-term solution. I will put 90% into some passive portfolio because that's the way I want to go. And 10% I would like to maybe allocate to one of the active strategies. Not to say that it's a play money, because I showed you the strategies, the active strategies, which I think are very, very reliable. But still, if you would like to see how this whole component works together, so you have passive portfolio and active portfolio, and you would like to see how it works as a whole, then it will be soon possible as well, because I'm planning to release so-called multi-strategies, so that you can put a different strategies or different portfolios and build one bigger portfolio. And also new strategies will arrive, some more strategies based on momentum, also mean reversion, and maybe somewhere in the future, and this is more long-term planning, dividend investing is not that simple, but I know that there's a lot of people interested in the topic, and I've been quite often asked if I could deliver something for those who are really in love with dividends. I'm not that person, but I know that is very, very popular. So, so this is it. And of course, there will be a lot of new improvements, smaller improvements and corrections so that it will be more user-friendly for you to follow. And now, if you'd like to get that software, then till the end of this month, you can still buy it at a lower price. And for 1 year, you have a price $179. So you have all I showed you available there. You have 40 permanent portfolios, over 40, and you can build your own. You have the global equities momentum strategy there. You have advanced equity momentum strategy there. You have the historical data up to 120 years. You have also the premium data, so over 70 exchanges worldwide. And you have also priority technical support. So basically that means that you have access to me. I'm the author of that software. I'm the person who's creating that software. So therefore I'm the best, I think, person to talk with if you are having any problem with that software, and I'm here to help you. So I would like to be sure that it's not that you will only buy the software and you will put it on the shelf, but that you will really make a usage of it, and that it will really make it it will be very useful for you, and that you will prepare a long-term solution for yourself using that software. So that's important. And also, if you would like to use it for more than 1 or 2 years, you can also be you will have a guarantee that this price will be the same in the future for you. Although inflation, whatever, you will have that price fixed. And this is the lowest price because, as I said, this price is only till the end of this month, and from the beginning of December, that price will go up. Instead of 179, it will be almost 200, $199. And by the way, the offer for 2 years is almost the same as for 1 year. Actually, it's exactly the same. The only difference is that there are two differences. Actually, the first one is that it's for 2 years, and another one, of course, it's a higher price. But if you are interested in active strategies, you would like to spend more time with it, with that software, then you can pay in advance for 2 years, and then you will have a lower price. So basically, it's like 41 cents per day. So really, if you are thinking long term, and you are looking how to invest your money wisely, I think that this is really a good way to spend your hard-made money, because what I'm showing you here is really and will really help you to prepare a long-term solution. And if you would like to buy that software, then I encourage you to go to my website, and there you can find the okay, maybe let me just a second put it here as well, systemtrader.show/shop, and there you can buy that software. It's all automatic, but if you need any help, you can just drop me an email. You will find all the information on the website. No problem there. I will help you as much as I can. All right, so this is it. And before I will finish, I know that there was one question, so I will go to that. Ricardo is asking, hi Jack, are you going to implement also forecasting tools like Monte Carlo simulation? Well, I don't know yet at this moment if I will put Monte Carlo simulations there. But if there will be really a high demand for that, and depending in which context as well you'd like to see Monte Carlo simulation, I'm not saying no, never say never, but at this moment I don't have such plan. But if really there will be a good justification to do it, currently I would prefer to focus on delivering some more strategies and to make the software more, let's say, user-friendly. But if really you will describe me what you would like to see and in which particular scenario you would like to use Monte Carlo simulation in my software, then I can consider it. I'm here to actually answer your questions. And actually, it's not only software for myself, but for everyone. So therefore, if there will be more people interested in any kind of functionality, and it's really reasonable, and it's really something which is good to have, then I will consider to add it to the software. So I think that this is all from my side for today. Thank you very much for your time. I highly appreciate it. I encourage you to go to systemtrader.show/shop and check the offer of that software, because I think it's really a great tool. And the data you can find there, which is going back to over even 100 years, it's really unique. It's really exceptional. You cannot find it in some free sources out there. And the price which you are paying here is really peanuts if you consider that you are building a plan for the long term, even for your life, for decades. And I think that this will be a really well spent money, and that you will be highly satisfied. If you have any questions, please drop me an email. Just visit my website, and I'm here to help you. Thank you very much for your time. Bye-bye.